What's going on, guys, and welcome back to another video. So Verizon released their earnings just yesterday, and I was always going to take a look at them just to see if there was anything interesting in there, and I figured that I might as well share my thoughts with you guys. So I'm sure we're all aware that Warren Buffett made an investment in Verizon back in Q1 2021. He purchased $9 billion worth of stock, and a lot of people were quite confused as to why he had done that, particularly because he sold a bunch of Apple shares and then purchased a load of Verizon shares, and a lot of people couldn't really get their head around that. So if we just sort of look at the stock chart for a moment, he made a purchase, Q1 of 2021, and I believe it was after the dip, so it was somewhere around pretty much where it's trading now, somewhere around between $52 and $55, and it just hasn't moved ever since. And then if you zoom out even further, we can see that over the last 5 years, there's been a return of 0.27%. So when you consider that the S&P 500 has returned 100% in the same time period, safe to say that Verizon stock has not done very well. But anyway, let's get into how their earnings were. And then towards the end of the video, I'll give you what I believe the company is worth, and whether I think, not necessarily whether I think that it was a good investment or not. That's not for me to say, because Warren Buffett doesn't need to be approved by someone on YouTube. But I'll give my reasons as to why I think he made that investment. So the first page of the earnings presentation is their earnings summary. So they reported adjusted earnings per share for Q2 of $1.37. Now, if you sort of extrapolate that out for the full 2021, then that would be earnings per share of $5.48, which shows a PE, or a trading PE, of about 10. So it seems quite cheap. But the problem with looking at PE ratio with a company like this is that they are absolutely riddled with debt. So you're looking at their price being their market capitalization. Really, you should be looking at their enterprise value, but we'll come on to that. So from the highlights, we can see here that their earnings per share of $1.37 were the best on record. So that's good. They're obviously improving their earnings. They've got adjusted EBITDA growth of 5.6% year on year. And I've just got something to say about using EBITDA for a company like Verizon. So I think EBITDA is a good metric. I sometimes use it myself, or I'll always at least look at it, right? But depending on what the company is, depends on how much weight you should put towards using EBITDA. So one of the problems, or it's not a problem because it's designed this way, but EBITDA is earnings before interest, tax, depreciation, and amortization. So for a very capital intensive business like Verizon, they have a lot of depreciation, and that's because they have a lot of fixed assets, and so fixed assets don't show on the P&L straight away. They show over a period of time, and that is the depreciation. Now, if you are stripping out that depreciation to completely remove it as an expense from your earnings, which EBITDA is doing, then it makes it look like you are in a way performing better than what the business actually is. So I think EBITDA is good, but you should only compare it between industries, really. So you can see here we've got depreciation and amortization expense, and for the first half of the year that was $8 billion. So if that continues in the same form, which it should do because they are fairly stable expenses, then that will be $16 billion for the year. So you can see how removing $16 billion from an earnings metric is going to have a massive effect. So EBITDA for a company like Verizon, I probably wouldn't pay too much attention to it compared with a company that is sort of less capital intensive. And then this slide here just goes on to say that they've had continued progress on the 5 vectors of growth, being 5G adoption, network monetization, next-gen B2B applications, customer differentiation, and new markets. So that's good. Particularly a lot of people are interested in the 5G adoption because at some point everybody will have access to 5G, and that is obviously a big market for Verizon. But honestly, there's actually not too much within this earnings report, which is probably why after hours the stock just hasn't moved at all. So we can see 0.2% is how much the stock has moved, and that's because they just didn't really give us too much. But obviously they gave us the financial results, which is the absolute minimum that they needed to do. But I think what I'm saying here is that they haven't given us too much to really get excited about. With that being said though, their total revenue is up 11% year on year, which is actually massive for a company like Verizon. Verizon is a slow grower at this point, if you can even call it that. It's very much a stable company. You're not expecting them to grow much, even with the 5G adoption. And you sort of know what you're getting. So 11% year-on-year revenue growth is actually fantastic. Adjusted earnings per share are up 16% as well, which is very good. One piece of advice that I would give you though, that I think you can take forward onto every company that you analyze, especially in this time, is that when you're looking at year-on-year growth figures, you have to bear in mind what the period was like a year ago from now. So this would have been June 2020 when we were very much in the midst of the pandemic. So you expect that the results would have been suppressed at that point. And for a company like Verizon, it's not a massive deal because they weren't massively impacted by the pandemic, but they were still impacted. So when we're seeing figures like 16% year-on-year growth in earnings per share and 11% year-on-year growth for revenue, you certainly shouldn't be expecting that going forward once we're comparing to a sort of a more normalized year. And that point that I make will be backed up when we look at management's guidance going forward and how much they are expecting the company to grow by, but we'll come on to that shortly. And then this page here just shows us the consolidated cash flow summary. So their free cash flows are always pretty good in this company. That is one of the good things about the business. It has seen a decline from this time a year ago though. But the main thing to take away from this page is the fact that their net unsecured debt to adjusted EBITDA is almost 3 times. So it's at 2.9 times and it was at 2 times. And I honestly think that anything above 3 and you really should start worrying. So considering how close Verizon is to that, is definitely something that you need to look out for. And then we can see here the 2021 guidance. So what I was referring to earlier regarding the year-on-year revenue growth being very high for this business, we can see that actually management's guidance for the full year is for revenue growth to be somewhere in the region of 3.5% to 4%, which is in line with typically how this company performs. Adjusted earnings per share being in the region of $5.25 to $5.35. So earlier on we said that 137 times 4 would have been 548. So this is more or less in line with that as well. So no surprises there. And then effective tax rates and capex are unchanged. So if we just look at the balance sheet and see how good or more likely bad the balance sheet is, we've got cash and cash equivalents of $4.5 billion, which sounds like a lot, but in effect, when you consider how much their liabilities are, it's really not a lot at all. They've got total current assets of $35 billion and they've got total current liabilities of $40 billion. So that's like a big red cross straight away. Not to say that I wouldn't necessarily invest in a business that doesn't have more current assets than current liabilities. That's not what I'm saying, but in terms of the things that I'm looking for, it's definitely not a tick. If we look to the long-term assets, they've got $350 billion of total assets. Take away the current assets of $35 billion. That gives us total long-term assets of around $315 billion. We compare that with total long-term liabilities of $234 billion. That looks okay, but if we actually look at what those total long-term assets actually are, so they've got wireless licenses, okay, fair enough, but they've got goodwill, which straight away I would just strip that out because you can't sell goodwill. And then you've got other intangible assets of $7 billion, which I'd probably take that out as well. So their total long-term assets, they still do cover their sort of total long-term liabilities, even after stripping out goodwill and other intangible assets, but it's still not great. The balance sheet of this business isn't fantastic. They have a lot of debt. So if we look at their debt, they've got $7 billion maturing within 1 year, which they don't currently have the cash to cover, which is fine. I'm not saying they're going to run out of cash, but it's just something to think about. And then they've got long-term debt of $145 billion, which again is not great, is it? I mean, $152 billion worth of debt is, it's just frightening. Now, debt in and of itself is not necessarily a bad thing. In fact, I don't think it's a bad thing at all. I think that every company really should consider having some form of debt just because it reduces your weighted average cost of capital. So debt is always cheaper than equity. And if you are raising debt to grow the business, then it is definitely a good thing. But I think that this company is overweighted with debt. I think $152 billion of debt on a company that's, their market cap's, I think, $230 billion. A little bit high for my liking, but I've not seen anything to suggest that they can't service the debt, so it's not like the business is going to go bust. But yeah, it would be nice if that was a little bit smaller. Okay, so before we get into what we think the company is worth using the discounted cash flow and earnings multiple model, let's just have a look at the historical performance of the business. So looking back to 2016, their revenues were $126 billion, and in 2020, they were just over $128 billion. So a little bit of growth, but not much. In terms of gross margins, actually, if we have a look at those, they've remained fairly consistent around 58, 59 or 60%. That's fine. Net profit has gone from $13.5 billion in 2016 to $18.5 billion in 2020. So That shows some really promising growth actually. Shares outstanding has remained more or less the same, so that's quite good that they're not having to dilute their shareholders and reduce your personal weighting in the company. The most interesting thing about this business though is their cash flows, right? So their cash from operations in 2016 were $23 billion and in 2020 were $42 billion. So that is amazing growth, almost 100% growth over those 5 years in terms of their cash from operations. Very, very good. If we look at their capital expenditures, they went from $17.5 billion to $20.5 billion. So whilst their cash from operations have increased absolutely massively, their capex hasn't actually increased that much, which means that our free cash flow has actually increased by 4 times. So that is very, very impressive, right? So their free cash flow as a percentage of revenue has gone from around 4% all the way up to 17%. And I can't help but think that this is one of the key factors as to why Warren Buffett has invested in the business, because their cash from operations have increased so much and they're not having to increase their capital expenditures too much in order to sustain that growth. So their free cash flows are just increasing year over year, and that's very positive to see. In terms of our forecast going forward, we've got free cash flow as a percentage of revenue being 12%, which is the average of the last 4 years. Terminal growth, we've gone with 1% because it's a slow growing business. And then for weighted average cost of capital, that's 4.4%, and you can see the inputs to that there. And we'll come on to that in a moment and why that's important. And then total debt, we can see here being $179 billion, which is just ridiculous. The reason it's a little bit higher than what we just saw is because that also includes lease liabilities, because they are also interest bearing. And so that's why I include them in my calculation here. And then based on those values, we get an average estimated intrinsic value of $70. And that is $93 according to the DCF and $47 according to the earnings multiple model. And that's using a PE ratio in 10 years of 12, which is probably about right, I would assume. And as is always the case, it will probably fall somewhere in between the two, so $70 is the average of those. That would provide a margin of safety of 25%. But that intrinsic value of $70 is based on a weighted average cost of capital of 4.4%. Now, I'm not saying that that is wrong, because 4.4% is the weighted average cost of capital. It's just a calculation and there's not really too much argument to be had there. And you'll see a lot of investors that will say, well, not necessarily investors, but there are a lot of people on YouTube that will say, I'm just going to apply a 10% discount rate to every single company that I analyze. And I don't agree with that. I don't think that you should do that because you're not taking into consideration the different risk levels for different businesses. So the reason why Verizon has a low weighted average cost of capital is because they are a less risky business than, say, a company that is a really high growth company and they have a higher cost of capital. In other words, an investor is going to want a higher return from a higher risk business. So to use the same weighted average cost of capital for every business is just wrong. However, you do have to bear in mind that even though the calculation is saying that you have a margin of safety of 25%, you're only discounting by 4.4%, so your returns in the long term aren't going to be huge for this business. And just to emphasize the point that I'm trying to make regarding the cost of capital or the discount rate, so for the people that would just apply a flat 10%, for example, and the sort of reason what people give is that that is the return that they want on their investment, but it doesn't really work like that, right? And the other point is that, again, it doesn't take into consideration risk. But for the sake of the video, let's just see what would happen if we just said, let's just apply a 10% rate to absolutely every company that we analyze. So if we were to have a weighted average cost of capital or a discount rate of 10% for Verizon, we would now be saying that the average estimated intrinsic value is $17. Now, I don't know about you, but I have a feeling that Warren Buffett would not purchase a company at a negative 69% margin of safety. So I think that's pretty much all I have to say on that. It's a ridiculous idea to apply the same discount rate to every company that you analyze. It's based on risk, which I think brings me on quite nicely onto how I'm going to close this video. So at the start, I said I was going to give my opinion on why Warren Buffett made this investment. And in my opinion, it's because he sees it as a low risk investment that's going to give him his 4% dividend yield per year and also maybe a little bit of capital appreciation. He probably doesn't believe that this is going to grow more than Apple. In fact, I'm sure he doesn't believe that. But what he probably does think is that this is a less risky investment than Apple, for example. I'm not saying that he necessarily traded this for Apple, but that was the case, that he did sell Apple shares and he did purchase shares in Verizon. So in short, he probably saw this as an investment where, although his returns were going to be low, his risk was also relatively low as well. So it's better than him earning, say, 0.5% 1% interest in the bank. He just figured that he would put the money into Verizon and leave it at that. But anyway, who knows why he invested in the business? I can't say that I've ever spoken to him personally, so I could be completely wrong there. But that is my thought. I think he sees this as a relatively low risk investment that is going to give him a low return, and he's happy for that because it's better than it being in the bank. But anyway, that is all for today's video. I hope you find it useful and I hope you've enjoyed it. But until next time, guys, thank you.